I'm either going crazy or I'm learning here because in the month of May, I sold over 100 shares of a dividend stock with a yield of over 8.5%, only to put some of that money and start buying one with a yield of less than 1%. And I want to share this quote with you, and it says, "Your goal as an investor should simply be to purchase at a rational price a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you will find only a few companies that meet these standards. So when you see one that qualifies, you should buy a meaningful amount of stock. You must also resist the temptation to stray from your guidelines." Big Warren B. from the Annual Letter to Shareholders, 1996. Hey, what's up? I'm Russ, and 1996 was the year that I went into the Navy and got on board the USS John C. Stennis. But I'm here with you, we're talking investing, and I'm sharing with you each and every week my learnings and my passion for passive income. And we're going to go through all the portfolio activity for the month of May, the dividends received, what we sold, what we bought, and take a little bit deeper look into that 8.5% massive yielder that we sold and the itty bitty teeny tiny one that we bought. I've also got a link below for something new here. It's a stock recommendation tracker to look at the performance of stocks that we share on the channel from this point forward, and also the world's shortest ad. Hey, did you know you can save a bunch of money on a Seeking Alpha annual premium subscription with my affiliate link below? All right, in the month of May, we received $183.80 from Nexstar Media Group, ticker NXST, $55.80 from AbbVie, ticker ABBV, $82.15 from AT&T, $51.50 from Enterprise Products Partners, ticker EPD. And our monthly payers, Main Street Capital, ticker MAIN, paid $36. Realty Income, ticker O, paid us $51.40. And Agree Realty, ticker ADC, paid us $15. For a grand total of $472.68 in dividends in the month of May. So let's run through everything that we sold, starting with our 100 shares of Leggett & Platt, ticker LEG, at $14.05, 30 shares of AT&T, ticker T, at $17.38 average price. We sold out of Simon Property Group, ticker SPG. Nothing wrong with them, just that I've kind of lost focus and I wanted to consolidate those 10 shares into some of the monthly payers. And a whopping 127 shares exited fully out of our Altria position at a price of $44.79. And on to what we bought, which was 6 shares of Johnson & Johnson, ticker JNJ, at an average price of $146.58. 2 shares of the Schwab US Dividend Equity ETF, ticker SCHD, at $77.78. 8 shares of monthly paying dividend stock, Agree Realty, which is a REIT, a real estate investment trust, ticker ADC, with an average price of $58.93. 12 shares of Vici Properties, ticker VICI, at $28.63. Went heavy into Starbucks after they fell hard at the beginning of May. $74.91 average price on 31 shares of S-Bucks. Non-dividend stock, Harrow Incorporated, ticker HROW, 10 shares at $16.39. Big fan of them, ophthalmologic company, big powerhouse in the making. I think maybe someday they will pay a dividend. That day is not today. Then we added, because it was dropping hard below our average, 3 shares of Nexstar Media Group, ticker NXST, at $158. Redeploying a lot of cash that we've had from past sales, sitting around 75 more shares of Enterprise Products Partners, ticker EPD, with an average price of $28.30. And then our brand new position, Visa, ticker V. 8 total shares in the month of May with an average price of $269.70. And there's a link for this spreadsheet in the description below. Man, I'm telling you what, we got more links around here than Pebble Beach Golf Course. You can see the E column, it's the Patty. It's not Patty McGee. It's not Patty Wackery going on here. No, it's the projected annual dividend income, which is your Patty. So our Patty, when you take the gain and subtract the loss, which there was a lot more loss than gain, gonna mean it's a negative number. Our May net Patty was $184.18, a negative. It's okay because we have $2,236.44 of cash on hand. Dry powder just waiting to be deployed. Stay tuned. Come on back. We're going to show you exactly the things we're buying. And hey, if you signed up for the newsletter, you'd have already known and been in the loop that we sold a dividend king, which was Altria. And just a couple numbers that we shared is that smoking is in decline, okay? Cigarette sales have dropped over 50% in the United States since 2000 and 70% since the early 1980s, and smokable tobacco makes up about 90% of Altria's revenue, and they're a company that's in transition. As they say there, right by themselves, I'll blow it up for you. They are moving beyond smoking, and smoking is 90% of their revenue. And as we shared from Simply Safe Dividends here, their total sales have gone up not that much. So they're clearly a very well managed business, but you have to have that revenue growing. Your sales have to keep growing because it's only going to work for a time. That management can do things like shares outstanding reduction, buying back shares, and financially engineering higher earnings per share numbers and things of that nature, which is exactly why I shared that 10-year total sales are up 15% for Altria over the last 10 years, 15%, but the shares outstanding have been reduced by 11%, but their 10-year earnings per share number, which is right here on the left, is up 91%. That made me nervous as an investor. Plus, if you look at their recent total return, remember that's with dividends received compared to the S&P 500, they did not beat them going back 1 year, 3 years, 5 years, or even 10 years. You had to go back 20 years and 30 years for Altria to beat the S&P 500. And as you saw, cigarette sales are declining. They're clearly a company in transition. And then most of all, they have a product. It is bad for people. It's unequivocally bad, undeniably bad for the health of the person that uses their product. So personally, we made a decision to not outright invest any longer into a business that hurts somebody along the value chain. You can find something wrong with any business, but I think we can all agree that long-term tobacco use will cause cancer. And then again, if you sign up for the newsletter, it's free. The low price of free. You will always see what we've been buying, dividends received, and selling, and all that good stuff. Now we'll take a quick peek at Visa. Feel free to pause the video if you want to look at any of these numbers a little more in depth, because Simply Safe Dividends is a little bit of a pretty penny, but a dividend safety score they give of 99, very safe. And check it out, their recession sales were even up 9.5%. I don't know how much you know about what Visa does, but they are not a bank. All that they do is they process the payment. They facilitate the payment from merchant to bank to the customer. That's all that they do. When a credit card transaction happens, Visa gets their cut of the money. Doesn't matter if somebody doesn't want to pay their credit card down the line. Visa's not affected by that, which is what makes Visa so unique. They have a massive market share, and I struggle to find a serious threat to their status as the leading payment processor of credit cards. But look at that dividend growth. Outstanding. They IPO'd in March of 2008. 18% 10-year CAGR, 16% 5-year, 16% last. They grow that dividend very quickly. So yeah, it's a small yield, but it is such a better company, and they're going to be growing that yield for a long time. Why? Because they have such amazing cash flow. But first, their payment details, $2.08 per share every year, and it looks like in the fall, they'll probably raise that dividend again. And their dividend yield is actually 10% above the 5-year average, which was one of the reasons I started buying. Their forward PE ratio is below the 5-year average, but I think this is a case of looking at product, something that may look expensive now, but it's such a great company, it rarely goes on sale or you can get it cheap. But I think that what looks like a fair value or maybe even a slight overpay now is going to look like a smashing deal 5 and 10 years from now. Their free cash flow payout ratio, 21%, stupidly low. Same thing for their earnings payout ratio. I mean, these are just sexy numbers. There's no other way to put it. Look at that free cash flow per share growth, massively up and to the right. They had one air pocket of sales growth there in 2020. Well, people weren't spending money, so they had night. But other than that, do you know since their IPO, Visa has never missed an earnings? They've never come underneath what the analysts expected. They just continually crush it. Their sales up and to the right. Shares outstanding have just been coming down very nicely. In 2023, they announced a $25 billion share repurchase program, so they will keep on doing that. I mean, these numbers are out of this world. Return on invested capital, we like to see 15%. Look at these numbers. 19% is a bad year. Fantastic return on equity. Free cash flow margin, last 12 months, 59%. That means out of every $100 that came in revenue to Visa, $59 was turned into free cash flow. Just outstanding. Operating margin, ridiculously high at 67%, and their net debt is 0.07%. It is stupidly low. They could just knock that debt out if they wanted to, no problems. And the interest coverage ratio, if you don't know what this is how many dollars of operating income does a business have to cover every $1 of interest expense on the debt. Visa is currently at $36.22, easily able to cover it. That is a story. Now this is over at finchat.io, but they have some 5-year returns here. Now return on capital employed is a look at what management is doing with the money. 20% is pretty dang solid. That's a very, very good number you want to shoot for. 28% is what Visa's got going on here. Their numbers are just outstanding, and this is why this business never goes on sale. And finchat.io has a price target of $307.61. I think years from now that's going to look like a bargain, so I'm going in, buying more Visa, and I plan to keep buying Visa. If you like this video and you got enjoyment out of it and found it useful, give it a thumbs up. And in this floating little box right next to my head, we talked about a stock that is stupidly easy to understand and may have almost 40% upside from where it's at. So click that little floating box, and if you do that, you'll find out which one it is there.